So to get going, I guess first and foremost, who the heck are you and what were you doing before Endowus?
Yeah, it's been a long journey. I'm a little bit older than I look. So I've been in the industry for 26 years, financial institution, mostly at Morgan Stanley. So 17 of that 26 was one company at Morgan Stanley in Hong Kong and Singapore. Various roles, but my last role was with the asset management division. So I was a portfolio manager in public markets equities for Asia and emerging markets, investing in growth stocks. And my last role was the chief investment officer. So I was on head of the investment side. And then for the last 4 years, I was the CEO. So I ran the business across Asia for Morgan Stanley Investment Management Asia. And then I retired at the ripe age of 43 at the time. And I kind of pivoted. I wanted a break and wanted to, join the exciting, fintech revolution. So I pivoted into fintech. And I was an angel investor when I was at Morgan in private securities. And then I set up an entity where I started investing in fintech companies. Sort of like a venture studio type thing, where I deployed, maybe 10 plus million in investments across fintech companies here in Singapore, Australia, Korea. Some you may know, a company called MDAC, for example, where I'm an advisor and was an early investor, and other such companies. But then, I had a kind of desire to do something more than just invest. Get my hands dirty. So I embarked on this entrepreneurial journey. Started in the beginning of 2018 with Endowus. And so been building the company up for 3 years now.
Very cool. Yeah. So in the spirit of Chinese New Year and prosperity and wealth, if we go back 26 years, what was the biggest investment that you missed in that investing career?
Throughout the 26 years?
What's the one that still wakes you up?
Really stands out? I don't know. I got most of them right. So I got Tencent.
Hashtag Endowus.
Hashtag Endowus, yeah. The one that I missed, I guess I missed the whole 99-2000 kind of tech bubble from a private securities opportunity. Like I didn't invest in like private companies early on. I was really focused on public markets. Yeah, so I missed that whole cycle, I guess.
Very cool. Very cool. And then when you got involved in angel investing here, MDAC's a pretty mature company, been around for a long time. What was the environment like early on, right after you retired, versus how would you contrast it with now?
Back then, it was like such a nascent stage. I think, most people were doing basic stuff, lending, payments, not basic stuff anymore. Especially the way Rapyd does it.
I know, right? Yeah. So it's very sad the way you position it, but okay, we'll take it.
So I come from an investment banking background, right? So when I look at commercial banking activities, I don't understand most of it, and that's why I think it's simple. But as you know, when you don't understand it, everything looks simple. But when you actually dig into it, it's really complicated. Yeah,
I was at JP Morgan in the transaction processing business, and we thought exactly that about investment banking.
That's right.
So you're right on. You're right on.
That's right.
Cool. And then, so what was one, can you define for us what Endowus actually is? Because I think it's, again, murky to probably many people.
Yeah. So I think what a lot of people bucket us into this robo-advisor bucket, which is unfortunate because I actually don't like that phrase, that word, because it's very misleading. But it's fine. I mean, we've given up, basically, right? Trying to change the way people use, it's common vernacular now. So, but the reason I have a problem with it is that they don't really have a robo. It's actually people doing it. Like it's in the finance world, it's called quant, systematic quant, whatever you want to do it. It's been around forever, and we use technology. Great companies like Rentec and Two Sigma and all these guys exist. We do that well. So I don't like the fact that it's called a robo, and they don't focus on advice. They actually build product. So a lot of these robos have fund management company licenses, and they build, collective investment schemes, financial funds, and they sell it on a digital platform. So I like to call Endowus a digital wealth platform. The way we differentiate it is we're not trying to develop an algo that's trying to beat the market. What we want to provide is good advice. We want to actually come alongside investors and their investment journey. We want to be there for them for the long term. So everything other than the Robinhood app, trading stocks and punting and trading short term, other than that, we want to be the wealth partner for everything else. So actually, we're disrupting the 99% of the market, which is traditional banks, the DBSs of the world. So we want to touch the $10,000 customer at DBS all the way to the 10 million plus customer at UBS. So that's the marketplace. We want to take care of your total wealth, not just a sleeve of it in a quant strategy, macro hedge fund, whatever you want to call it, or a REITs fund. We want to manage all of your funds. And so we partner up with the biggest global and local fund management companies who are the experts in manufacturing product. So it's almost like an Amazon model. It's an open platform. It's a total wealth solution. It's a digital platform, and we want to manage all of your wealth.
And how many investment houses do you work with now in that regard?
I think we're up to about 20. So all the big ones, Vanguard, BlackRock, Aberdeen, Schroders, all the local guys, they're all our partners, strategic partners, and also, in bringing in products and giving access to solutions. We really focus on the advice piece. So 3 things that we really do well and we want to continue to do well is advice, access, and cost. So give advice to people through their life's journey in investing, saving and investing their money. Our motto is actually help people invest better so that their life is easier today and better tomorrow. So it's a simple catchphrase that we use, and that's really what we want to do, is make their life easier and help them to invest better.
And so the first product category, correct me if I'm wrong, was focused on CPF. Is that right? Is that wrong? It could be wrong too.
It's actually not exactly correct.
Okay.
But that was where we wanted to start our business with CPF. And the reason is because we want to, as I said, manage your total wealth. And in Singapore, CPF is such an important component of everybody's wealth. It's 37% mandatory saving of your monthly salary, which is huge. It's the biggest, I think, in the world. And that compounds over time to a number that gets to hundreds of thousands or millions. So it's a piece that I think is really important. One of our missions is really helping you solve retirement, which is increasingly becoming a societal problem. It is, I think, the biggest societal challenge we face right now in this generation. And so we're trying to help people solve retirement and prepare for their financial future better. In order to do that holistically, we need to include CPF. So the company was set up with the specific intention of accessing CPF money. It took us 2 years, but we got approved by CPF at the end of 2019. So as of October 2019, we became the first and so far only digital advisor for CPF money. So our digital platform allows you to manage your CPF, your SRS, and your cash savings, all of your source of funds on a single platform for the first time here in Singapore.
Nice. And how has the market reception of that been so far?
It's been great. We've been around for 3 years as a company. We're actually completely bootstrapped. We don't have a single external shareholder. It's all partner managed. That's why we're not in Tech in Asia announcing big fundraisers like some companies we know.
Some of us retired at 43.
Yeah,
so.
Precisely. But joking aside, not that we didn't want to, but we just knew that we had a very specific purpose, a specific mission and vision for the company. We thought that external capital was going to dilute that effort. We needed CPF to be in the bag, kind of, as a service for us to launch a full public retail solution. And so that happened really at the beginning of last year. So January 2020. So 2020 was really year one for Endowus. And it was a phenomenal year. We published our year in review. We grew assets by 7x, our client base by more than 10x. We are actually officially the fastest growing digital wealth platform in Singapore. Faster than the pace at which other more famous,
more talkative,
faster speaking foreign founders. We are the fastest growing. We're not quite the biggest yet, but here in Singapore, I think we may be able to overtake them this year.
This year? Okay. Which month would you say that will be true?
I don't know, maybe...
Okay. Fair enough. And so when you put the team together originally, I mean, how many founders are there, and how did you approach building that initial team, knowing we have a lot of other startups in the house?
Yeah, so we have... we don't actually use the term co-founder or founder. We say founding partners. And so we have, I think, 4 key personnel, 5 And everyone's a co-founder, right? We're still early in our journey.
It's the Rocket Internet model.
Yeah. I actually didn't know that, but
Yeah, everyone's a founder.
Everyone's a founder. Okay. It's a good mantra. Yeah. Not that I believe in Rocket Internet ethos, but that's
Everyone's
fine.
a founder.
Everyone's a founder. Great. And so, yeah, I mean, I think the company was the genesis of the idea, especially related to CPF, was from one of the co-founders, Yuning Sun, who's still with us, and also Greg Van, who you know well.
I
We
do.
were together at Grab. So Greg started the payments business with Joel
At Grab.
at Grab.
Yeah.
When it was, Grab Taxi and cash only, right?
It's true.
Grab Taxi, yeah.
And My Taxi. My Taxi.
That's right. And so, Greg, Yuning, myself, Sin Ting, who's our Chief Client Officer, used to be on the Morgan Stanley Private Bank with me, and also Ju, who is our CTO. And we have an exceptionally talented team that we've been able to build up over the past few years.
And I think very, very heavily weighted to people that have industry experience. Is that correct?
Yeah, not always, but most of them. And that's been intentional because I think that we want to be deep tech, but also deep fin. And that's something that's really needed. We are a licensed entity. We're a professional service provider, like a doctor or lawyer. So we need to be competent in what we do. What's really important to us is also fiduciary duty. So, as a wealth service provider, a direct-to-consumer service provider, we really are focused on doing our fiduciary duty, working in the best interest of the clients.
Right.
That's why we introduced, industry-first standards like 100% trailer fee rebates, being completely fee-only, not being paid by anybody else other than the client, so our interests are perfectly aligned. And things like that, we're really trying to be a little bit more differentiated in that way, in the competency and integrity.
So being a long-standing industry expert, right, with a senior pedigree, where do you feel like some other sexy startups that might talk a lot are on the wrong track from a customer protection standpoint relative to the industry?
Okay. I'm not I don't know. In general, financial technology companies, I think, are pretty robust, and they have to be in a place like Singapore. I'm looking at the MAS folks over there. Not that they are regulators, but the regulatory team. But in a place like Singapore, in a very advanced nation, with rules and regulations in place, and as a licensed entity, I don't think that anybody would be falling short of that requirement. But what I do want to highlight, especially in the space that I'm in the wealth space, is what people get away with within that framework. And the thing that I would highlight the most is being paid commissions for selling financial products. In most developed nations, it's actually illegal now. In Europe, even in Australia, close to home, it's like akin to a doctor prescribing you a medicine because you're being paid a commission from the pharmaceutical company. And, I think it's just ethically and, fundamentally wrong. And so we need to make those changes. Unfortunately, most of the incumbent financial service providers in the wealth space make their money that way. Yeah. So it's banks, it's brokers, it's traditional fund platforms, even private banks. They all make money by selling funds and pushing products where they get commissions and paid tremendously, and much more than from the client itself. But that person who is a client, they get paid by these financial institutions through the back door. So I just think it's complete misalignment. It doesn't always work. Sometimes it does, but it doesn't get in the way of serving the needs of the clients, but I don't think it's aligned to do what's in the best interest of the client. Yeah. So we want to change that. And so Endowus is, forging ahead with, best practices and best global standards.
And so how did you approach that, right? Obviously you have to have a business model and you have to cover your costs at some point or right away. So how are you bringing inventory in? What do your customers end up paying? Yep. What expense ratio or other costs are people paying? Yeah, so
one thing that we did from the get-go, and because I'm from the space, I know how the inner workings, are. So one thing that we introduced was institutional access to institutional funds. So we know that GIC would never pay the fees that the average Singaporean pays through a bank channel for buying a mutual fund, right? It's actually 10x or 20x. If you're a private bank client and you have a lot of money with a bank, then they give you access to some of these institutional share class funds, which are 1/3 the cost. So in a way, Endowus is like group buying, to access institutional share class funds. So even like big global companies like PIMCO, all the major fund management houses would give us access to the institutional fund because they would look at us as an institution. And we would allocate that to individual retail customers. No one did that before because it was just too lucrative to rip off people, So that was one thing. Another thing was sometimes the institutional or the clean share class is actually not the cheapest way to access a fund. It's actually to get the retail fund, but get paid a huge rebate or commission. And so we worked out a huge rebate or commission, but instead of keeping it, we introduced 100% rebate. So we give that all back to the customer, the client. So that achieves a lower net total expense ratio. So things like that. And then, really looking out to the market globally and regionally, looking for products that doesn't exist here in Singapore. Great funds, like we just launched our new series of ESG sustainable investing funds. Most of them were not available here in Singapore. We worked with fund managers to bring them into Singapore at costs that were unachievable before. So things like that, really thinking out of the box, looking for products that are not existing here, and then introducing it to the market and negotiating a special fee so that clients can access it. So really democratizing access for the individual retail investor.
And that shift in fee pricing, right? And I remember in the U.S. went through this a couple decades ago.
Right, that's right.
Do you attribute that to the size of the market relative to the competition, or is it in other markets? Is it actually driven on the regulatory side? What drives that change usually?
So there's three pieces actually. There's a demand side, there's a supply side, and there's a regulatory framework. So the regulations, obviously, we're not there yet. And MAS is a market-driven regulator. I think that's the phrase they use. And so, they look at the market and kind of in a laissez-faire attitude, and they will do more, I think, in the future. And hopefully they'll move towards global standards in protecting the consumer. But we're not quite there yet. So I think there are definitely improvements, but we can do much more at the regulatory level. On the demand side, it's the consumer. So Singaporean people are great, nice people, but a bit too, docile, very nice. So they don't fight for their consumer rights. There's no big consumer advocacy groups. It's changing a little bit. These financial bloggers and, we have one in the crowd, but there are people who are advocating for the consumer more increasingly. So there's a demand side. We need to ask for change. We should not be, laying low and just taking it, lying down when DBS or other guys are ripping you off, right? You should fight for it. And, private banks especially, you can actually go and negotiate. Most people don't know. You can actually negotiate fees. And we have a couple of clients who came to us and said, oh, I want to look at your products. And we said, oh, these are our fees. And they're like, wow, that's your fees? And then they went to DBS Private Bank or UBS Private Bank and said, oh, Endowus is offering this. And they said, oh, we'll offer you the same fees. So they've been charging these like ludicrous fees for 10 years. And then Endowus comes along.
That's the relationship I have with StarHub.
It's a great relationship.
Very healthy.
Yeah, healthy relationship. Yeah, it's for mutual benefit. But yeah, that happens all the time. It actually is possible to lower fees. And so you can negotiate better fees for private banks. And so, yeah, we're working to change that demand side. And then the supply side, we're not very, that's what the Endowus team is trying to do, is to improve the supply side. The supplies of the services in wealth, because the incumbent guys will not change. But, we're already making changes, right, when we impact those clients who go and negotiate a better fee. We hear that DBS or UBS are talking about us and our model. And if everybody moves to a fee-only model because it's the best way to do things and they don't want to lose market share to us, then that's how we're going to change the industry. So the supply side will change too.
Yeah. Once they start trashing you, then you're on the right track usually.
That's right. We're starting to get that actually.
For sure. And do you feel like your customers are now more educated?
It's a long process, education, it takes a long time. So financial literacy in Singapore is improving a lot. It's like, I think one of the most advanced in Asia, but a long way behind a place like the US, for example, right? So, yeah.
Pretty educated marketer
Yeah.
compared to your average American investor.
Yeah.
It's just a big market.
But I think there's also, a lot more opportunities to invest in great products and best practices because of the scale of the market.
Yeah, it's just a large market.
There's a large market.
American supermarkets are big too.
Precisely. Yeah. Costco.
Exactly. The things we miss. In terms of, and I'll move on to maybe other topics, but I tend to repeat the same facts again and again and again. So here's one fact I learned a long time ago. But what portion of long-term investment returns is actually attributable to lower fees versus higher performance? So how important is this mission long-term for your investors?
Okay. So the maths is that if you can reduce fees by just 1% a year, that compounds to 150% returns over 30 years. So the magic of compounding returns, we heard about it, eighth wonder of the world. It really is a huge, huge impact.
So this is the fight to fight to get the fees.
This is a
as low
fight to
as
fight.
possible.
Even 1% difference, and CPF investing used to be ridiculous. It used to be as high as 6-7% upfront first-year fees.
Yeah.
We've reduced that to less than 1%.
Yeah.
And that's something that even CPF, when we first went to them, didn't think it was possible. But we achieved it from the get-go at the end of 2019, coming to this year. So imagine that 5% savings a year.
Yeah,
and how that compounds over time, right?
Yeah, no, that's what I've found personally very surprising about the robo-advisors, right? Is that the expense ratios, from my perspective, still seem pretty fluffy.
It's fluffy and high. Absolute numbers
very
are still
comparable
high.
to like a domestic equity fund in the United States,
Yep.
whereas ETFs are 4 basis points kind of thing, 4 to 15, which seems like a big difference compared to what people are willing to pay for from something that's theoretically robotic or quant.
Yes. It's a real problem. I think if you add on all the fees of the robo-advisors, including their own fees, which starts at 60 to 80 basis points, and then you add on the underlying fund level fees, and when you start touching esoteric stuff like China Internet, the fees for the ETFs are like 79 basis points alone. So you advertise a low number, but actually the actual number is much higher in implementation. And then you add on like FX cost. If you access US ETFs, there's a two-way cost, which is quite meaningful. And then you access, you have the withholding tax issue. So if you invest in a US listed ETF for S&P 500, where the dividend yield is 2%, that's actually a 30% withholding tax on that. So that's 60 beeps of additional cost that you lose. All these things add up to almost like 2%, I think, 1.5 to 2%, which is ludicrous. In my view. So DIY, you can access ETFs by yourself in the US, through a discount broker and access that at really low cost. You still have the FX piece, you still have the withholding tax, but it's probably cheaper for you to do that. But the more efficient, tax efficient option here in Singapore is to access the UCITS ETFs, which is the European listed ETFs, which exempts you for half the taxes of withholding. So it's actually 15%. Instead of 30%.
So it's the same asset manager, different shares are legally held elsewhere or managed elsewhere.
Yeah. So there are better ways to do things, but it's difficult for the individual. When you have a job, when you have children, you have a family to raise, and all these things going on in your life, you want a trusted partner who will always work for you, be on your side to lower costs at every layer. Think about these FX costs, think about these tax implications, and try to solve this for you. And that's really what Endowus is really trying to do.
So the .us is the us power.
Yeah, Endow us.
Exactly.
Right.
So we've established I was totally wrong about your first product, being CPF-centric. Well, what is the product family today? There you go.
Yeah.
What's the product family look like today?
Yeah.
And I think you announced some pretty interesting stuff a couple of months ago around cash, et cetera. Can you define what you're doing?
So we launched CPF in October of 19, SRS Solutions in November 19. Really, we start with the core portfolio. So in financial language, we're trying to lower the cost of beta. So lowering the cost of market access. In Singapore, it's still very difficult to access global markets. It's fine to do an STI ETF, but Singapore is less than 1% of the global market, right? You want to invest in the best companies around the globe. You want to buy an S&P 500 passive ETF, which would be 4 basis points in the US. It doesn't exist here. And there's nothing here, nothing in Sing dollars as well. So it's really a very difficult environment. Maybe it's because the market's small. I don't think so. I think we can solve it. It's a chicken and egg problem. The fund managers and SGX, we had Boon Chai on our annual virtual conference last week, and he's a good friend. He says that there's no demand. But I can see a lot of people, bloggers talk about, ETF buyers through DIY, through these brokers in the US and USIS. So I think there is a market, and it's a growing market. I think people are understanding passive is a really good way to expose yourself to global markets. So I think there's enough demand. We just need the fund managers, guys like us, and the SGX and everybody to come together to really push forward and find a solution that works for Singaporeans. So I think a passive solution, and we're trying to solve that ETF problem as well with the SGX and our partners. And so passive investing, core investing, lowering the cost of beta is something that is very fundamental to the service we want to provide. But after that core allocation that you put in globally diversified low-cost portfolios across equities and fixed income, after that, we launched a cash smart solution. So it's cash smart because interest rates are really low and your bank deposits are not giving you the yield. Fixed deposits, it locks you in for 1 year or 2 years and gives you 0.3%. So we have come up with a product that mixes institutional deposits, money market funds, and in some cases short duration fixed income products as well, to get you a really safe 1% or a little bit juiced up 1.5 to 2% kind of return. And it provides you with daily liquidity, no lockup, minimal investments, and you can go in and out and use it as a cash management account. So that product we launched in July of 2020. And then a few months after that, in October, we launched the final piece, which is the Fund Smart platform. So that is an open fund platform where we put in the best-in-class funds for each category that we can find. So if you go to a fund supermart, normally you have like 2,000 funds from 200 different managers. If you want to buy a US equity fund, you have like 50 or 70, and you don't know what to choose from, which ones are good. We've just taken all that work out for you. We've done all the work of fund management due diligence, fund due diligence. We've negotiated the best rate for you and given you access to the institutional share class or provide you with a 100% rebate and get you to a lower net fee. And so if you want a US equity fund, there's 1 or 2 max, depending on the style. So you don't have to really worry about it. You know that Endowus is always going to fight for you to get the best product and the best-in-class funds. And so we launched that Fund Smart platform. It has about 60 funds now from 20 plus different fund managers. We will continue to add to that and have different categories. So we have ESG that we just launched, sustainable investing, which is really core to our mission as well. And then we will have income. We will have other products that will meet the needs of clients, basically.
And you, in this case, just so I'm clear, is basically non-Americans, right? So it's not just Singaporeans, but it's also definitely not Americans. Is that correct?
I'm sorry, but we may be able to resolve that, and we'll let you know when we do.
Please.
Yes.
And that's not about me, but
not about
it's
you.
also about us.
There is a lot of demand, yeah.
Yeah, but anybody basically
region.
who's here, right, who isn't, you don't have to be a Singaporean citizen. You have services for everybody. You mentioned SRS, and now the Open Fund Mart or cash management would appeal to everybody, right?
That's right. So, and you can do your core portfolio, your satellite investments, you can do cash management, you can do everything on one platform across CPF, SRS, and cash, all your source of funds.
Present company accepted.
Present company accepted. And we actually have an American who has a CPF and he wants to invest in CPF and we can't do it.
I know.
It's ridiculous.
I got one.
Yeah. We're trying to solve it.
My CPF returns are just not where they should be. I mean, you mentioned a couple of times, right, cash management account, right, which is an industry term. Are you going down the path of also providing margin, a debit card, QR code payments? Where does cash management account go for you?
Yeah, I mean, all those things are possible. As I said, we really want to put our ears to the ground, hear from our clients on what the priorities are for them to manage their, wealth. I think we have heard from a few that maybe, direct payments to settle credit card bills, or actually issuing a credit card or debit card could be something that we can look into. It's not right now a huge priority for us because we have a lot of things to do. But it's definitely in the 2020 things to do list. So things like credit cards, insurance is something that we've talked about. internally and with clients. We actually have regular sessions with clients. We have surveys that clients provide us with feedback on. So we really listen and try to prioritize the things that really matter to them. And so all those things, ETFs, all those things, everything except the Robinhood stock trading stuff, GameStop, that part we will not do, but everything else related to managing your wealth we'll do.
Does Elon Musk have an opinion on Endowus?
Stonk. No, just kidding.
Not yet?
No. Not yet. Yeah.
We'll get him there soon.
We'll get him there soon. Yeah.
I'm sure. In terms of the distribution side of the business, right? How have you gone about acquiring customers in terms of on the investor distribution side?
Yeah. It's been interesting. So the traditional digital channels, obviously, we use all of them. SEO, SEM, all the social media channels. Actually, YouTube is coming up very strongly these days as a great acquisition channel, and so that's interesting. So there's developments, but what's worked for us really well is content. So we have always on content, written content. So we actually launched Endowus Insights, where we write articles every week on personal finance, CPF, investing, and everything. And we did that for over a year before we launched any service. And so we actually got nominated by SGX for an Orb Award for financial journalism, for financial literacy, even though we're not a journalist or a financial publication. And we've been going strong ever since on the written stuff. But COVID, we had a couple of events at SGX where we sold out the big hall, overflow in the gong room. 300 plus people turned up for our events. But when COVID hit, we transitioned to webinars very quickly. And that was a masterstroke because we regularly, and it was a weekly cadence. So every Wednesday we would hold an Endowus Insights webinar. We would regularly have hundreds of people live and a few thousand watch afterwards. And I think that, wealth is really, financial services in general, but we're in the trust business, especially when people are going to come and give all of their life savings to you. You need a very high level of trust. So being able to show our competency, not only in our expertise and our experience, but also the way we've built the platform, but content has, I think, been a really, really good way to build trust with our client base and our audience, and also conversion. I don't know how many clients come to us and say, "Oh, I enjoyed your webinar. I watched your webinar, and it led me to your platform." And they search our website and open up an account. So content and building trust that way has been really, really a powerful tool for us in converting clients and acquiring them. Yeah.
How, just sticking with, starting back with the pandemic at this point, what did your team have to do to adapt as things, because you really just, as you said, started to really market yourself publicly. The funds had really just kind of come out a few months into the process, and all of a sudden we hit circuit breaker. How have you adapted in the last 12 months?
I think we changed everything, almost everything. We actually had spent zero marketing dollars prior to January 2020. So we'd been around. We had a beta service, alpha service, a credit investor service, and a retail service that we launched for cash that we ran as a test, building our internal tech stack and capabilities and experience and platform stability. But when 2020 January came, we said, okay, now we need to start marketing. We need to start branding. So we actually took out the MRT in Raffles. And I don't know if you saw it, but we had Greg's face and everybody's face all over it.
I had to start using a different station. So.
Yeah, that's right. Yeah, I avoided it too. I see enough of him in the office. But actually, that thing started, and then within 2 weeks, circuit breaker. So no one was around in Raffles. So we quickly took that down. We ended that very quickly and moved on to digital very aggressively. So it changed our marketing strategy. The way we work, everybody was offline. We did everything that you guys probably did as well in terms of trying to bring people together, stay sane during that time. And we grew rapidly. So we grew in terms of personnel from less than 20 to now almost 50. And that happened throughout last year. So we more than doubled our team. Our assets grew by 7x. Our client base grew by 10x. So all of these things happened during that period. And for us, I think we hate to say that we're a COVID beneficiary. I don't think we are, but I think we just I think people I think, were more receptive to an online digital wealth platform as a result of being at home, having to do a lot of things online. So yeah, I don't think we were hit from a business perspective. It's just the way we implemented and grew the business that had to change.
And do you find that people now had the time to do some of the things they felt they should do, and you became one of those should do's?
Not enough of them. We want to obviously do much, much more. But yeah, I mean, the clients that we interact with are, we have like a very, I guess, ardent and strong, client base who are fans of the product, who are rooting us on as supporters of the business. And I think we're really aligned, and so they're really strong supporters of our ethos and what we're trying to do in terms of changing the way business is done in wealth. So we're very excited. We actually just ran a client advocacy campaign, and all of the clients who were on that campaign were unpaid clients who were advocates of our business. And we have a face in here that many of you are familiar with who was on that campaign. So we're really grateful to our clients because they really do speak out for us. And I think the word of mouth has been a powerful tool in growing our business.
Wonderful, wonderful. So I'd love to take some questions from the floor, since we do have a lot of folks who took the trouble to come here today. As an entrepreneur, what is keeping you up at night?
There isn't much, that I'm worried about. I think the financial service business is, it's a people business. I think, people are the ones that come up with the ideas, run the business, meet the clients, provide the services, find the solutions. So it really is a people business. It's a human capital intensive business. So you hire the right people, you empower them, you give them the tools to, execute well and succeed. So for me, I'm very fluent in the investment part of the business, the marketing, the strategy, everything. But I don't know anything about coding and technology. And we're a fintech company. Half our team is engineers and developers. Our technology stack is, cutting edge. It really is. I think it's the only tech platform that, really can do the full capabilities of wealth. For example, CPF. The reason we are the first and only CPF digital advisor is because of our tech stack. It's a unique tech stack where we can handle CPF flows. Every other robo or technology platform was built with a two-step. It's the robo to the broker and into the market. We have to go through 5 different institutions when we touch CPF money. We have to pull money from CPF and SRS, and it's a completely different flow. It's a very sophisticated and difficult flow. A lot of the pipes is offline and very old, and so we have to deal with that. So we have to make it robust. It's very unique, and we have invested very heavily to build that really well. And it's a very flexible wealth tech stack. So it's the only one of its kind. And so that's unique to us. And that's what keeps me up at night, the technology platform.
Do you see yourself at some point opening your supermarket to people that today would view themselves as competitors?
Yeah, so I've talked about this before. Because we're an open wealth platform and we work with fund management companies, the other 2 major robos here have fund management licenses and build fund products. So yeah, happy to have Stashaway's, what looks like a macro hedge fund type model product onto our platform. We can do that. Size REITs product or a ARI growth fund. All of those can be on our platform. We don't have any problems. It has to be best in class though. So I'm going to just stop there.
There you go.
So would you be able to support international investors from other markets in Asia at some point?
The technical answer is yes. We cannot market to overseas markets, but if it's on a reverse inquiry basis, for example, they heard of us or they just found us and they approach us, then we are technically allowed to take on clients from overseas. But effectively to service them well, we would need to be in those markets. And so we have ambitions for regional expansion. We're licensing in Hong Kong, which is another major wealth hub. So that would probably be our first overseas market. But the priority for this year is to go deeper and broader and really dominate the Singapore market. I think the environment is very polarized, let's say, because we hear a lot in the press about GameStop and Robinhood and all the trading craze that's going on. And yes, there is a portion of the market and investors who are doing that. And then you come to Singapore and you have a lot of investors who only hold two things. The predominant asset ownership here is in real estate and fixed deposits. So that's it. So in Singapore, financial asset ownership, especially in financial markets, is actually quite low versus developed markets, surprisingly low. And so there is tremendous opportunity. It's actually a $1 trillion wealth market here, including offshore money that has come to Singapore. So Japanese money, it could be Indian money, it could be Korean money. And because Singapore is like the Switzerland of Asia, it is the wealth hub of Asia, right? So there's a lot of money here. So getting a small market share of such a big market is, even if we get 1-2%, that would be amazing, right? So there's tremendous opportunities for growth for Endowus in this wealth market because of the size of the market. And I think that as people become more financially literate, they will be much more robust in their asset allocation. So move away from real estate, which is low yielding and maybe capped in terms of upside. They'll move away from fixed deposits because it's negative yield, right? It's not giving you anything. And in terms of real returns, it's negative. So people will gravitate to financial instruments. And I think like in Japan, we may move to zero or negative interest rates. But the funny thing is in Europe, fixed income did really well last year because we moved from 0 to -1%. That's a capital gain in fixed income. So bonds make money, capital gains, when prices move up and yields go down. So it's the delta that generates the returns. So we need to move away from this concept of yield, fixed income being a yielding asset class, to fixed income being a capital gains asset class. So as long as interest rates continue to move from 1 to 0 and 0 to 1, you're making money in fixed income. So I think that's the concept that people need to understand, and that's why fixed income remains a very important tenet of your asset allocation and a source of diversification alpha. So I think there's tremendous opportunities to summarize in Singapore to grow, even for core products like equities and fixed income. And we have enough products, enough solutions that meets the needs of clients for that core allocation. And so we'll take money away from DBS, we'll take money away from UBS and grow. That's taking from the 99% of the market because they still dominate. We can talk about robos and all these guys all you want, but 99% of the market is owned by the DBSs of this world. So in 5 years' time, we used to say 10 years, but now we say 5 years. In 5 years' time, we'll be like, why did I ever go to a bank or a broker or a fund platform for wealth services? I just go to Endowus. It's better, easier, cheaper, and they fight for us. Yeah. Basically, one thing that we have introduced to build a higher level of trust, especially because here in Singapore, last year in March, we had a robo-advisor exit the market during March. So clients were forced to sell their assets and exit the market. So there is a little bit of a concern around robos and digital platforms and security of your money and stuff like that. So we get a lot of clients saying, "I sent you money, did you get it?" and it's not that fast, but so we get questioned about that. And so what we've done is worked with the largest domestic broker. So Singapore's largest broker happens to be UOB Kay Hian. So we work with them, and they are our execution broker and agency broker. So that we built, every client of Endowus opens up a trust brokerage account in their own name on UOB Kay Hian's brokerage system. So it's unique and differentiated from some of the other robos who self-custodize or use commingled vehicles. So we actually never touch a client's money. It goes directly from a client's bank account to the UOB Kay Hian trust brokerage account in their own name. And the money can only be sent back to their bank account in their own name, nowhere else. So Endowus doesn't get involved. We don't touch the money. It goes from, DBS Bank to UOB Kay Hian and then back. So the flow that's the flow. So we call that a double ledger system because we keep track on a digital basis of all your assets, your transactions, and everything through our microservices structure. And then, UOB Kay Hian also keeps it. And we've asked them to move digitally, but they still send out a physical monthly statement. Right. Some people actually like it because it's real. For us, being environmentally conscious, we would rather move to digital, but it's fine. So that's one unique aspect, and that's a way to build trust. And so it's been important for us to do that well. Yeah. So I was actually slightly late today because I was finishing off an article on the Business Times. So Endowus has a monthly column on the Business Times. It's called The Science of Wealth. So this month, I just wrote an article. I won't steal the thunder, but it was on that specific topic. And so look out for it on Saturday when it comes out. We publish it on our Endowus Insights. What can I say? I mean, it's crazy, but it's something that is not new. I saw it in Asia in the early 90s, the China A-share bubble, the tech.com bubble, bubbles exist in a normal cycle everywhere. The activities of retail investors, I think there's a lot of good things about it too. It's not all negative, meaning that it's part of the financial education process. You learn, you try things, you fail, you lose money, but hopefully you learn from that experience. I think retail investors being more empowered is a good thing. But the channels through which they feel empowered and now they're realizing that it's actually not, and I'm specifically talking about Joel's hidden nudge about how Robinhood makes money and how they actually sell the business to hedge funds and other market makers and traders. And so Robinhood is I think it's just a sign of the times. Mm-hmm. I think retail activity is a confluence of events. COVID, you're locked up at home, you got a check from the government that's free, you have nowhere to spend your money, so your savings increase. A lot of these macro things happened that were out of your control. You have these now trading apps which are free, but are not, but are free to access, and therefore you have easier access to financial markets and trading, and churning doesn't cost you. You have this societal kind of problem. Social inequality, economic, financial inequality is a major social issue, especially in the US. And so, it's a confluence of all of those things that I think has brought us to where we are, and GameStop and, this demonizing of hedge funds and, retails empowering themselves to, overthrow things and revolting and stuff. So yeah, I don't think it's anything new, to be honest with you. I've seen it many times in my 26-year career. Multiple cycles in Asia, in developed markets. It's not even a geographic thing. It's a worldwide phenomenon. And hopefully people learn from the experience.
Yeah, and as data gets more valuable, right? And the tech opens up the market, right? You create more of these opportunities for new business models. Right? I remember 10, 12 years ago, we used to talk about dark pools, right? Yes. That's really what we're talking about here is how does the data get into the pool, how does it get out of the pool, and what the heck's going on in the middle, right? Any other questions? We're going to have another session right after you guys grab some refreshments. We're going to talk about the Rapyd platform and how it facilitates the securities industry, moving money, et cetera, et cetera. So I did want to save some time for that. All right. Thanks very much, Sam. Pleasure having you. And look forward to seeing more of you.
Great to be here.
Thanks.